Good morning, everyone. This is Justin Roberti. I am writer and producer with Benzinga. Thank you so much for joining us. We're about to interview Fred Thiel, the CEO of Marathon Digital Holdings. So let's go ahead and bring Fred on. We'd like to talk to him a little bit about all of this business with Bitcoin lately. Good morning, Fred. How are you, sir?
I'm great, thank you. How are you?
Good. Thank you so much for coming on. It seems like Marathon Digital Holdings had an excellent week last week for its shareholders. Why don't you tell me a little bit about what happened?
I think it's a combination of announcements. We've announced our growth goal for this year and updated guidance. We had said previously we would be at about 35 exahash. We've now said we're going to be at 50, which is almost 100% growth over last year,
Right.
which is great news. And then also, we've had some very good successes with some of our block wins, obviously. People have been looking at the Block Explorer. It's a great thing about this business. We're fully transparent. People can see our revenue as we generate it minute by minute. And, there were some great blocks just right after the halving with, 18 and 16 Bitcoin per block in transaction fees. So it was quite a great week.
hmm Sure. And of course, the halving could impact fees directly, but it's also encouraged a lot more participation, hasn't it? It seems like the ETFs have also opened up Bitcoin exposure to billions of new potential investors without necessarily even having to participate in blockchain or in Web3 in any way, without having to have a digital wallet. Do you think that is the mainstreaming finally here? Are people finally coming to regard Bitcoin as digital assets in general as just another form of assets?
Well, I think a couple of things have happened. The ETFs being approved, and realize there were 11 ETFs that were approved, um, essentially provides one level of legitimization, which means the regulators now have a way that they believe is applicable for retail investors and institutional investors to buy, hold, and kind of trade Bitcoin, if you would. The ETFs, they believe, is a great vehicle for that because it allows them to control the on and off ramps, and it's a cash settled asset, um, which gives them a little bit more control as well. The real thing we're seeing with the ETFs is that it is still so early. The only real participants that have been buying and investing in the ETFs are predominantly still retail investors. The institutional
Mhm.
investors have only just started dipping their toes in the water. I know Morgan Stanley has only recently said they're going to begin to train their RIAs on how to sell the ETFs. So we have yet to see the real rush. What we've essentially seen is retail enthusiasts, people who are aware of Bitcoin, people who already were comfortable with Bitcoin as an investment, dipping their toes in with the ETFs. But even with all that said, the ETFs, four of the Bitcoin ETFs were the four most successful ETF launches ever. And if you look at the total amount of assets under management, which is slightly over almost $60 billion of assets, that's about 60% of what gold has achieved in 20 years in the way of
Mhm.
assets under management. So, very successful ETF launch. Impact on the price of Bitcoin. It likely pulled forward some of the price appreciation we would normally see later in the cycle. But
Mhm.
it's essentially created a daily demand of about 2,000 Bitcoin that needs to be found somewhere, and there are decreasing balances of Bitcoin on public exchanges. And you have to realize there's only about 2 million Bitcoin in circulating supply, generally available on exchanges today. So this is all bodes well for long-term demand. And the halving added a little bit of a supply shock where we decreased from 900 new Bitcoin issued a day to 450. And so that, together with the demand from ETFs, is providing some upward pricing pressure on Bitcoin, where historically after a halving, you would have seen a drop in the price of Bitcoin before a run up happening.
Mhm. It seems like the ETF wrapper would be more for traditional finance guys than necessarily, at least the crypto enthusiast type of retail investor, because it's something that it's an instrument that they've been familiar with for about 30 years. What do you think has been the reluctance for institutional involvement in Bitcoin and I think also Ethereum ETFs?
Well, I think, Ethereum is still up in the air as to how the U.S. regulators are going to deal with it. The CFTC and the SEC are arguing about whether it's a commodity or a security. And at the end of the day, the ETFs are regulated by the SEC. But in regards to Bitcoin, if you look at the ETFs, what it effectively has done is taken the risk of you open an account on an exchange, your coins are commingled with other coins, potentially your cash is commingled with other cash. This is scary. Look what happened to FTX, etc.
Sure.
Now with the ETFs, you can call your broker, you can call Fidelity, you can call, wherever you happen to hold your equity investments and things like that. You can buy ETF shares. They're custodied by regulated third parties. There's a much higher degree of comfort and safety. What you have to realize, though, is that the ETF settled T+1, which means they're actually settling the day after you do the transaction. And so there can be slippage in the price of Bitcoin, meaning it can move up or down between when you bought a share in the ETF and when the ETF buys the underlying Bitcoin. And so you just need to be aware of those differences. But if you're like most savers who are putting a small percentage of their assets into Bitcoin every month or a handful of times a year, then that really doesn't matter. You're buying for and holding for the long haul. And by everybody's estimates and analysis, Bitcoin has outperformed almost any asset class, whether it's over the last year, last 5 years, last 10 years. So it's been a great asset to be in, and I think everybody should have some small portion of their savings in Bitcoin.
Do you think that it's taking the place of digital gold, as everyone's been saying, which has been viewed as a it's been a 10,000 year long term investment after all. I mean, gold is, I mean to say, it's been in circulation as a currency, as a store of wealth, and a means of exchange for about 10,000 years in human history. It's hard to look at any single thing that has a better track record or a more long standing track record. Easy to see how Bitcoin has made more gains than gold. That seems like a cherry picked argument in some ways. It doesn't have anywhere near the stability. Can we have purview into that, since we've only been monitoring it for about 14 or 15 years? Does it have anywhere near the stability to deserve that comparison, or does it just kind of remain a blue chip among crypto?
Well, remember that the volatility in an asset is what drives the returns, right? If the equity markets were not volatile, people wouldn't invest in them. Right? Bond markets provide that level of security, right? You're going to get a coupon payment every year for the principal that you paid for the bond. Equity markets are more you're betting on the risk and the return that you're going to get because of growth in the underlying equity. You invest in Bitcoin because you want growth in the value of the asset. You invest in gold because you don't want to lose money. There's a very different reason for investing in gold than investing in Bitcoin. But even so, a 2% allocation to Bitcoin, and there are many analysts who have done this. Fidelity has published papers on this as well. A 2% allocation to Bitcoin in your 60-40 portfolio provides a significant uplift to the returns you're getting with minimal downside. A 2% drop in the value of your portfolio is totally affordable by the vast majority of investors. And when you look at that weight against the return, it absolutely makes sense. Gold is an asset that, interestingly enough, the supply isn't limited in the same sense that Bitcoin will only ever produce 21 million Bitcoin, and then that's it. Gold, you keep extracting it out of the ground. The emissions rate, meaning the rate at which new Bitcoin are released through the mining process, is now significantly lower than that of gold. So gold has a higher inflationary nature to it than Bitcoin does. Essentially, the gold miners are printing more gold. Right. But what we're seeing is longer term, for the same reason that Warren Buffett likes to invest in gold miners versus holding underlying gold. I think you're going to see that people will again start investing in Bitcoin miners now post-halving as a way to get that extra beta over just the spot price of Bitcoin. And I think the gold and Bitcoin are going to operate quite similarly in certain market conditions. In other market conditions, Bitcoin tends to correlate more with equities or a risk-on attitude. And both are very driven by monetary policy. So when there's loose money, more money can go into investments, more money tends to go into riskier investments like Bitcoin. when there's tight monetary policy, people tend to put their assets into cash or other things. And so I think what we're going to see over the next few years here is that a period of extended, what I would call high interest rates compared to what we've seen over the last 20 years. Inflation is likely not going to be at 2% anytime soon. I think we're going to continue to see inflation being very sticky and persistent, and that's going to delay the Fed's ability to do interest rate decreases. But at the same time, the economy is going to start slowing down. So I think the Fed's going to be in a very tough place. But if the monetary policy of who's ever in government next year is to print more money, add liquidity to the marketplace, reduce interest rates, et cetera, then I think you're going to see Bitcoin tear upwards because a lot of capital is going to flow that way.
Do you think that a bright future for Bitcoin is dependent upon a change of administration?
No, I think Bitcoin, listen, it's an asset class that is over $1 trillion. You now have millions and millions of people in the US who hold it and use it. The SEC has said that Bitcoin is a commodity. The fact that you have ETFs says a lot. And you now have sovereigns and governments starting to hold a small portion of their assets in Bitcoin. You have corporations like MicroStrategy and others putting Bitcoin on their balance sheet. So I think the horse is out of the barn on if they could try to prohibit it. It would almost be like going back to the 1930s when ownership of gold was prohibited because the federal government wanted people to invest in savings bonds. Don't think that's going to happen here. What I do think is going to happen is a clear distinction between Bitcoin and the overall crypto per se, stable coins, all these other altcoins, et cetera. Bitcoin is an asset class all to itself. It's a store of value. It's an accepted market, if you would, market instrument that institutional investors can use for holding assets. There's plenty of liquidity in the marketplace, so you can start trading large volumes, large amounts of assets. And I think it's really here to stay. The other digital assets, time will tell. I think Ethereum still has to go through some major regulatory hurdles before that really gets greenlit to the same extent.
But overall, we're getting there. I mean, the SEC was an inconstant friend to the crypto world last year, to put it mildly. Hopefully, this year is a little bit less exciting than last year was. Of course, less Sam Bankman-Frieds and so forth will probably really help. I've noticed. First of all, it's worth noting that Marathon Digital, you're holding, if I'm not mistaken, over half of the mining capacity that we know about right now. Is that correct?
I clarify the question a little bit. Do you mean that our?
I believe that through acquisition, you have over 50% of mining capacity, while reducing operating costs. Tell me a little bit about that transition. What has the strategy been there?
So we started the business around an asset-light strategy. The purpose of this was you want to scale as quickly as you can because scale gets you revenue and profitability, cash flow, and an ability to raise capital, which lets you continue to scale. If you look at your typical Bitcoin mining site, there's infrastructure that has to go in, and then you have the Bitcoin mining rigs. And so about 30% of the assets that would be invested of the CapEx would go to infrastructure, 70% to miners. We basically said, we are going to allow other people to make the investment in infrastructure. We'll host our miners with them, just like you would at a co-location facility for data centers. And then we're going to put every dollar we have into miners so we can scale faster than anybody else, which we did, and we became the biggest miner in the world. Now what we're doing is we're consolidating the sites where we currently have capacity, where our miners are running, by buying them. And we're able to buy them now at a price that is less than it would have cost us to build them. And so we're going from an asset-light strategy to a portfolio approach. And in December, we owned about 3% of our capacity. Today, we own about 54% of our capacity, meaning the infrastructure that our capacity runs on. And by the end of this year, it'll be a greater percentage than that as well. So as we continue to grow, it'll be predominantly an owned and operated capacity.
And of course, miners are constantly hedging against and having to manage the cost of energy and of materials in order to make mining profitable. Marathon has made a push to reduce emissions and find cleaner energy. Is that a matter of good PR, or is that a matter of good business sense?
Well, it's good business sense. Here's the reason why. Today, we're at about 56% of renewable energy that we use. Um, Using stranded renewable energy, so solar farms, wind farms, et cetera, old hydro dams, where today they can't sell the power because either they don't have interconnect or there's congestion on the network, the grid network. Think of it as there's more water trying to get through the pipes to the end consumers than the pipes can handle, and so it backs up at the generation side. Well, that's power that those generators can't sell. And especially with renewable energy, wind and solar, it's zero marginal cost to produce a kilowatt of electricity. And
Right.
so if they can't sell that energy, it's lost revenue. They have no costs associated to it. So if they can sell it at some cost to us, then we can use that energy. And over the years, as they eventually get an interconnect, then we'll move our miners to another site. And so it's becoming attractive for us to now look at owning actual potential, mature solar and wind sites, because it would be a way for us to control and own our own power.
Right. Perfect. So just to wrap it up, 2024, even coming into it, ETFs approved very early in Q1. The halving, of course, just happened as we all expected. These tend to be bullish signs for Bitcoin. Are more people looking at exposure not only to Bitcoin, but to Bitcoin mining investments? And how do you, without this being financial advice, ladies and gentlemen, because it is not, of course, what do you see playing out throughout the rest of 2024?
Well, I think what you're going to see is AI and Bitcoin mining competing in the capital markets and in the energy markets for capacity. Obviously, this explosion in AI is causing a huge hunt for compute capacity, which requires power. And so now the AI industry is out trying to do what the Bitcoin miners are doing. But there's one very significant difference in that. Bitcoin miners can shed load, they can shut off their systems at any time and give that load back to the grid. AI doesn't have that flexibility. It needs to keep churning away. And so I think what you're going to see is people are going to be viewing Bitcoin miners that have access to good stranded energy and have good energy policies about how they manage their energy are going to outperform Bitcoin miners that are just focused on lowest possible cost. The other thing that's going to be very important is diversification, um, both geographically and industry wise. So we operate on 3 continents, 11 different sites. That gives us great diversity from regime, risk, taxation, regulation, all of those things. It also gives us a better palette, if you would, of energy offerings that we can use. Additionally, we're doing things around energy harvesting, where we're taking waste material, methane, and or biomass from like landfills and other places, turning that into energy and turning that energy into heat, which we can then feed back into an industrial process. Notice I didn't say Bitcoin mining. Bitcoin mining is what generates the heat, though. And so if we
Mm-hmm.
essentially can get paid to generate heat and we can get paid to process biomass and methane, then we mine Bitcoin at no cost.
Right. All right. Well, excellent. Thank you so much for taking the time to speak with me today, Fred. It's been great talking to you, and we look forward to finding out how things are going to work out in mining for 2024. It certainly is an exciting time.
Great. Thanks for having me.
Great. Thank you very much. Take care.